Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at SanDisk.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so let's unpack a situation today that is just completely dominating institutional chatter right now. We're looking at a market move that, honestly, it looks like a data error the first time you see it.
Oh, absolutely.
Right. I mean, over the past year, we are talking about a stock that has rallied 2,314%.
It's just a staggering return profile, and it's one of those things that forces you to completely reevaluate everything you thought you knew about the business.
Yeah, to put that momentum into perspective for you, if you were tracking this stock a year ago, it was sitting at just over $32 a share. Today, it's trading around $815.
Right.
So we aren't just looking at like a cyclical rally here. This is a fundamental tectonic shift in market positioning.
Yeah, moves of this magnitude, they really demand a highly critical analysis of the underlying mechanics because, the market simply does not assign those kinds of multipliers to a company that's just maintaining the status quo.
Which is exactly our objective today. We're breaking down how a brand that honestly most people associate with mundane consumer commodities, the flash drives sitting in your desk drawer managed to orchestrate this kind of historic rebirth.
Right. The Nvidia of storage, as sell-side analysts are calling them now.
Exactly. We need to figure out what drove that transformation, examine whether the structural foundation can actually support this valuation, and ultimately unpack what this institutional consensus means for your own wealth-building strategy.
Well, to really understand that transformation, we have to go back to February 2025. Prior to that, SanDisk was operating just as a division within Western Digital.
Right. They were just part of the larger whole.
Exactly. It was effectively a cog in a much larger legacy hardware machine.
So what did that spinoff actually look like operationally? Because, companies spin off divisions all the time to clean up their balance sheets, but it rarely results in a 2,000% return.
Yeah, no, that's a great point. The spinoff was really the primary catalyst because it allowed management to execute a total operational pivot.
Okay.
Rather than trying to be, everything to everyone in the broader storage market, they detached from the parent company and committed entirely to the AI inference cycle.
Let's define that for the listener really quick, because when we hear AI, I think the immediate thought goes to the massive data centers training those large language models.
And that distinction is vital. Building and training those models requires astronomical computational power, and that is the traditional GPU demand cycle that drove so much hardware growth over the last couple of years.
Right, the training phase.
Yes, but inference is the second phase. Inference is what happens when that trained AI model actually goes live into the real world.
Like when you ask it a question?
Exactly, to answer prompts, generate video, run autonomous vehicles, or manage enterprise software.
It's the real-time, day-to-day thinking of the AI.
And that real-time thinking, it requires retrieving immense data sets instantaneously. You can have the most advanced AI processor in the world, but if it's just waiting around for a slow storage drive to load the necessary data,
You got a bottleneck.
a severe operational bottleneck. So management recognized that solving this specific memory bottleneck was going to be the most lucrative opportunity of the decade.
I'd love to hear the actual numbers backing up this pivot, though. Like, how did that strategy translate to their most recent quarter?
Well, the fiscal second quarter of 2026, which ended January 2nd, it really validated the thesis for institutional investors. They brought in $3 billion in total revenue.
Wow.
Yeah, which represents a 61% increase year over year. But the truly compelling metric is within their data center segment.
Okay, what are the numbers there?
That specific division generated $440 million in Q2 revenue. That's a 76% jump.
That is massive. And that growth rate really brings us to the margin profile, which honestly is the part of this story that I find most difficult to wrap my head around.
It is pretty unprecedented.
Right, because historically, consumer memory products operate in a highly commoditized, race-to-the-bottom environment. We usually see profit margins sitting in the low 20s.
Exactly.
But based on the current financial models, management is projecting non-GAAP gross margins to hit the 65 to 67% range in the third quarter. Plus, they're guiding for a 1,200% earnings growth for the year.
Yeah, it's a margin expansion that completely upends traditional valuation models for a hardware manufacturer.
It's like a fast food franchise that survives on tiny margins and high volume, suddenly pivoting to Michelin star dining, but somehow keeping their massive global scale.
That's a great way to put it.
They are theoretically making triple the profit on every single plate they serve. But I really need to push back on this premise for a second.
Sure.
Maintaining a 65% profit margin on physical hardware, especially memory, which has always eventually succumbed to price wars, it just sounds almost impossible to sustain.
Yeah.
How are they avoiding competitors just undercutting them on price?
So the resistance to price degradation really comes down to two things: an aggressive mix shift and proprietary technology. They are no longer heavily reliant on selling those low-margin consumer goods.
Right, the stuff in the desk drawer.
Right. The production capacity has been rapidly reallocated toward high-margin enterprise solid-state drives. And more importantly, to use your Michelin star analogy, their unique ingredient is their high-bandwidth flash technology.
Okay, so what makes this high-bandwidth flash so immune to traditional competition?
To understand why, we have to look at how they redefine their core product, which is NAND flash. For anyone newer to the hardware side, NAND is just the industry term for non-volatile storage memory.
The kind that keeps your data even when the power is off.
Exactly. Now, standard NAND memory is far too slow to keep up with AI inference. On the other end of the spectrum, you have high bandwidth memory, which is incredibly fast, but it has to be attached directly to the processors.
Which makes it expensive.
Outrageously expensive. And very difficult to scale for massive data centers.
So it sounds like they found the missing middle ground here.
They engineered it. Their high-bandwidth flash bridges that exact gap. It delivers the retrieval speeds required for complex AI inference, but at a price point that allows hyperscale data centers to actually buy it in massive bulk.
Oh, I see.
Yeah, they hold pricing power because they're offering a highly specialized solution to a desperate problem in the AI ecosystem, and legacy competitors just haven't been able to match it at scale.
But, to sustain pricing power and those massive margins, a company needs total control over its production. You can't command a 65% margin if you are bottlenecked by your own component suppliers.
Which brings us to the structural foundation of their wealth-building narrative. The industry is currently facing a projected structural shortage in this specific type of advanced memory.
Really? A shortage?
A massive one. Current forecasts show this shortage persisting all the way through 2028. Institutional capital is recognizing that demand is vastly outpacing the physical capacity to actually manufacture these drives.
Meaning whoever can guarantee supply during a multi-year shortage effectively controls the market.
Precisely. And this is where their corporate structure provides a massive competitive advantage. They operate as a pure-play storage company.
Unlike the competitors.
Right. When you look at their primary competitors like Samsung or Micron, those are massive, diversified conglomerates. They're dragging around entire legacy divisions dedicated to older standard memory or consumer appliances, display screens.
But because SanDisk spun off in 2025, they don't have to fund those slower growing divisions.
Exactly. They can funnel every single dollar of capital expenditure directly into high-margin enterprise AI storage. Furthermore, they secured their manufacturing base by extending a massive joint venture with Kioxia through 2034.
Wow, okay.
Yeah, that locks in factory capacity during a global shortage and guarantees significant cost advantages. On top of that, they established a dedicated partnership with SK Hynix, specifically focused on building out the high-bandwidth flash architecture.
Okay, I want to stop you right there because I spotted something in the financial research that seems to completely contradict this whole pure play narrative.
Oh, go on.
The core thesis here is that their major advantage is being a pure play NAND flash company, right? Free from the burden of legacy memory divisions.
Right.
Yet the research indicates they recently deployed $1 billion to acquire a 3.9% stake in Nanya Technology.
Yeah.
And Nanya manufactures DRAM, which is a completely different type of volatile memory.
Yes, they do.
So if the whole point of the spinoff was to avoid being a messy, multi-product conglomerate, why are they dropping $1 billion to buy into a DRAM manufacturer? It looks like they are drifting right back into the operational bloat they supposedly escaped.
It's a very fair critique, and it really highlights how complex modern hardware architecture has become. But that acquisition actually reinforces the strength of their supply chain mode.
How so?
Because to build these ultra-fast AI storage drives, you can't just use NAND flash. You also have to install DRAM inside the physical drive itself to act as a buffer.
Can you explain how that buffer mechanism actually works in practice?
Sure, think of the data flow. When an AI model is processing massive amounts of information, that data comes in much faster than the NAND flash can permanently write it.
Okay.
The DRAM acts as a lightning-fast, short-term memory vault. It catches and holds the incoming data momentarily, organizing it before passing it along to be written permanently to the slower NAND flash storage.
I get it. So without that DRAM buffer, the speed of the high bandwidth flash is severely compromised.
It absolutely is. So they absolutely have to have DRAM components to build their flagship product.
They do.
But they have zero desire to actually run a DRAM fabrication plant. The DRAM market is famously cyclical, requiring billions of dollars in constant upgrades just to stay relevant.
Right, they don't want the headache of the factory.
Exactly. By taking a $1 billion minority stake in Nanya, they secure a guaranteed multi-year supply of those vital DRAM buffer components.
They get priority access to the parts without having to manage the factories making them.
It is the ultimate form of strategic vertical integration. They ensure their assembly lines won't halt during an AI supercycle because of a missing component, but they don't take on the operational drag of running a legacy DRAM business.
Okay, so let me recap. We have a company with an unbreakable supply chain moat, operating during a forecasted multi-year structural shortage, generating unprecedented margins. When institutional capital models out that combination, it triggers aggressive price action.
Yeah, the technical momentum we're seeing is a direct reflection of Wall Street scrambling to reprice a fundamental shift in market dominance.
And the momentum is honestly historic. I mean, following the news of their deepening AI partnerships, the stock saw a 21.4% gap up.
Incredible move.
Days later, it logged a 9.86% single-day gain, followed by another 4% jump the very next session. We're looking at a single stock providing enough upward pressure to help fuel a 7-day rally in the broader S&P 500 index alongside Intel.
And, a major catalyst for that specific concentrated burst of upward pressure was the resolution of a massive structural headwind.
Are you talking about the Western Digital liquidation?
Yes, I am. Following the 2025 spinoff, Western Digital retained a substantial equity stake in the new company. Over the past several months, institutional investors were keenly aware that Western Digital still held 7.5 million shares that they intended to sell to raise cash.
I think it's important to clarify why a legacy owner holding 7 million shares suppresses the stock price, even if the underlying business is beaming.
Yeah, in institutional finance, that is known as an overhang. When major portfolio managers want to accumulate a position in a high-growth stock, they need liquidity.
Right.
If they know a massive shareholder is waiting to sell millions of shares into any price rally, those portfolio managers will sit on the sidelines. They won't bid the price up because they know the legacy holder's selling pressure will immediately push it back down.
They refuse to provide exit liquidity for the previous owner.
Precisely. Once Western Digital fully liquidated that final block of shares, the overhang was eliminated. The institutional mandates to wait on the sidelines vanished, paving the way for massive funds to start accumulating aggressively without the fear of a massive supply dump capping their upside.
And the influx of institutional interest has been intense. We are seeing analysts like Mark Newman from Bernstein issuing a street high price target of $1,000. We even have the launch of a 2x daily long leveraged ETF tracking the stock, which is just a glaring signal that retail and speculative demand are hitting a fever pitch.
Oh, absolutely. And you also have to factor in the persistent acquisition rumors circulating through the institutional back channels.
The idea that one of the major hyperscalers might just buy them out completely.
It makes complete strategic sense. If you are a trillion-dollar cloud computing giant, your entire future revenue model depends on dominating AI inference. Securing your hardware supply chain is an existential imperative.
Definitely.
From an enterprise perspective, acquiring the premier supplier outright might actually be more cost-effective than fighting rival tech giants for limited allocation during a structural shortage.
Which brings us to a really critical valuation problem. Right now, the stock is trading around $815. Yet the current consensus analyst price target is sitting at $770.32.
Right.
We are actively trading significantly above the consensus target. How should an investor process that? It feels like trying to appraise a house in a neighborhood where no one has ever sold a property before. Traditional comparable metrics just don't apply.
That is an excellent way to frame it. The market is currently in a phase of aggressive price discovery. When a company transitions from a cyclical, commoditized hardware business into a monopolistic AI infrastructure provider, the historical valuation models just fracture.
They break down completely.
Analysts relying on 5-year trailing averages to forecast future earnings are going to chronically underestimate the revenue potential. However, a prudent wealth-building strategy requires acknowledging that sustained price discovery above consensus targets introduces massive volatility.
Which is the perfect transition to the bear case. Because regardless of how flawless the financial models look, stress testing the thesis is non-negotiable. When an asset in a portfolio is up over 2,300%, ignoring potential foundational cracks is just poor risk management.
Absolutely. Blindly following momentum is a dangerous strategy, and there are highly credible risks that could disrupt this forecasted supercycle.
So the most immediate one that genuinely spooked the market was the algorithmic efficiency panic back in late March. This was triggered directly by the announcement of Google's TurboQuant algorithm.
Right. Google revealed a major breakthrough with TurboQuant, which allows AI models to process data with vastly improved efficiency. The immediate reaction from the market was severe anxiety.
Oh, yeah.
The institutional logic was straightforward. If AI models become exponentially more efficient, they won't require as much physical, high-bandwidth memory storage to function.
If the AI needs less hardware, the structural shortage disappears, and those 65% margins evaporate.
Oh.
We saw a sharp sell-off based on that exact fear.
We did, but that initial panic was based on a fundamental misapplication of behavioral economics. Specifically, it ignored the Jevons paradox.
Let's break down how that paradox applies to tech infrastructure for the listeners.
Well, in economics, the Jevons paradox states that when technological progress increases the efficiency with which a resource is used, the rate of consumption of that resource actually rises rather than falls.
Interesting.
Yeah, if you make AI inference significantly cheaper, faster, and more efficient to run, the global tech ecosystem doesn't decide to use less AI. They integrate it into absolutely everything.
Right. It's the commuter analogy. When automakers engineered highly fuel-efficient vehicles, people didn't end up buying less gasoline. They realized the cost of driving plummeted, so they moved out to the suburbs and started commuting 50 miles a day. The efficiency created massive new demand.
And TurboQuant does exactly that for inference. It doesn't destroy the demand for memory. It democratizes AI. If models become hyper-efficient, we won't just see them in massive data centers.
We'll see them everywhere.
Every smartphone, industrial sensor, and connected vehicle will run complex, localized AI. And every single one of those localized devices will require high-margin, solid-state storage.
So the efficiency risk is likely just a mispriced catalyst for further expansion. But I want to pivot to a risk that cannot be easily dismissed by economic theory: geopolitics.
Right.
We discussed the strategic brilliance of the joint venture with Kioxia, locking in manufacturing capacity through 2034. But that joint venture anchors their supply chain heavily in Asia. Is this concentrated physical footprint the actual vulnerability in their strategy?
It is undoubtedly their most significant, unmodelable risk. The global semiconductor and memory supply chain remains exceptionally fragile. By keeping their primary manufacturing concentrated in the Asian theater, they are deeply exposed to tariff fluctuations, sudden trade restrictions, and regional geopolitical instability.
Because at the end of the day, you cannot download physical storage drives over the internet.
The physical reality of hardware is inescapable. If regional tensions escalate and shipping lanes are disrupted, it won't matter how robust the demand for high-bandwidth flash is. If the product cannot physically cross the ocean, revenue halts.
Yeah.
While they are capitalizing on domestic R&D incentives like the CHIPS Act too, their heavy reliance on overseas fabrication remains a complex geopolitical liability.
And the market isn't going to wait years to see how these dynamics play out. We don't have to guess when the volatility will hit. As we look at the catalyst calendar, the market is going to stress test this entire thesis in a matter of days. Today is April 11th, 2026, and the upcoming schedule is incredibly dense.
The next 3 weeks are populated with actionable structural events.
First on the docket, April 20th, 2026. This is the date of their formal inclusion into the Nasdaq 100 index.
An index inclusion is a massive structural event. Trillions of dollars in passive index funds and ETFs track the Nasdaq 100.
Trillion.
When a company is officially added to that index, the portfolio managers don't evaluate the valuation multiples or the geopolitical risk. Their institutional mandate physically forces them to buy the stock to match the index's weighting.
It triggers a wave of blind, automated purchasing.
Yes. It guarantees a massive influx of institutional capital, which historically establishes a very firm floor of price support in the short term.
But the timing here is what makes this so fascinating. Because just 10 days after those passive funds are forced to buy, we hit April 30th, 2026, the Q3 earnings call at 1:30 p.m. Pacific. The market has priced in absolute perfection.
Oh, they absolutely have.
Investors are demanding that management hit their guidance of $4.4 to $4.8 billion in revenue and $12 to $14 in earnings per share.
It creates a high-stakes compression event. The index inclusion provides the initial capital wave, but the earnings call will define the fundamental reality. Management has to step up to the microphone and definitively prove that those 35% margins are actually materializing. If they validate the margins and offer forward guidance suggesting the supercycle is accelerating, the current price discovery phase will be strongly validated.
Looking slightly further out on the calendar, toward late 2026, the company is expected to hit a major engineering milestone with their 500-layer storage technology, known as the BiCS10.
This milestone is critical for mitigating the risk of future competition. In the memory sector, density is destiny.
Explain the mechanics of a 500-layer drive for us. Like, how does layering actually increase density?
Well, for decades, memory manufacturers tried to increase storage capacity by shrinking the memory cells and packing them closer together on a flat surface, like a sprawling suburb.
Makes sense.
But eventually, you hit the laws of physics and the cells interfere with each other. The solution was to build vertically. Instead of a flat suburb, you construct a skyscraper.
So they're literally stacking the memory cells on top of one another.
Exactly. Reaching 500 layers means they can pack an astronomical amount of data into the exact same physical footprint inside a data center's server rack. Data centers are desperate to maximize their physical space. If SanDisk successfully commercializes the BiCS10, it effectively guarantees they will continue winning the premier enterprise contracts, maintaining their technological moat well into the next decade.
Bringing all of this research together into a cohesive view for a wealth-building strategy, we're looking at an enterprise that has executed one of the most lucrative strategic pivots in modern hardware history.
Synthesizing the underlying fundamentals, the depth of their supply chain moat, and the structural shortage in AI storage, the consensus analysts scoring from the research places this firmly at a 9 out of 10 on the bullish scale.
That reflects exceptionally high institutional conviction.
It does. It indicates that the institutional consensus is treating this as a multi-year buy-and-hold thesis. While the impending earnings call and the geopolitical realities will inevitably inject short-term volatility into the price action, the overarching narrative is driven by a generational shift in computing infrastructure. The general institutional consensus is that attempting to trade in and out of a structural shortage projected to last until 2028 is a flawed strategy.
The research suggests accumulating quality infrastructure plays and holding through the market noise. We've watched SanDisk successfully evolve from a low-margin commodity provider into a critical pillar of the AI ecosystem, which leaves you with an incredibly important question to consider regarding your own strategy. As you analyze your portfolio today and look past the obvious trillion-dollar tech giants commanding all the headlines, ask yourself, who is the next boring legacy hardware company quietly building an undeniable monopoly right under our noses?